Assalamu alaikum class. Today's lecture is about the calculation of the cost of money, or in other words, the calculation of interest rate or the rate of return or the yield on your investments. So let's discuss what do you mean by the cost of money or what is cost of money? The cost of money refers to the price paid for using the money, whether borrowed or owned. Every sum of money used by corporation bears some cost. The interest paid on debt capital and the dividend paid on ownership capital, that is, you can say uh, share capital or debt capital means your long term liabilities, are the example of cost of money. The concept is crucial in finance, investment, and business decisions. Cause the choice of capital structure basically depend on the cost of money. That's why it is very important concept in finance, investment decision, and business decisions. In simple words, we can say that the cost of money is the price you pay to use someone else money. Someone else money means for example, borrowing money. When you borrow money, this is called long term liabilities or debt, or the opportunity cost of using your own money. Your own money means you issued capital, or you issued shares or capital stock. So whenever you get money against your capital stock or share capital, then this is your own money. So on your own money you have to pay dividends, whereas the money you borrowed you have to pay interest. Both of them are the part of the cost of money. To elaborate further, we will cover the chapter 6 from Fundamentals of Financial Management book, which is written by Brigham Houston. The problems from this chapter discuss two main types of investments, that is the treasury bonds or and the corporate bonds. So let's differentiate what is the difference between treasury bonds and the corporate bonds. We have a few difference. First of all, issuer, who issue basically these bonds. So treasury bonds are issued by government. Generally, T bonds or T bills are issued by government to fund their own spendings, government spendings. And the corporate bonds are issued by the companies for business expansion or their operations or their acquisition or the acquisition of any long-term investment or any asset. So the issuer are different. Treasury bonds issued generally by the government. The next difference is the risk level. Treasury bonds are usually less risky, or you can say it is the safest investment because it is backed by government. The risk of default is extremely low in case of treasury bonds, whereas corporate bonds, the risk basically varies depending on financial health of a company. High risk means the high yield or high return, whereas low risk means low yield or low return. So generally, the risk level is higher in corporate bonds as compared to T bills or treasury bonds. The next differentiating factor is interest rate. The interest rate are in treasury bonds, interest rate or rate of return is lower as compared to corporate bonds, because we have just discussed in point 2 that high risk means high return. So corporate bonds are more risky as compared to treasury bonds. That's why T bonds rate of return are less as compared to corporate bonds, because less risk, less return. Next is maturity level. Means you can say that treasury bonds they have long maturities ranging from 10 to 30 years, whereas corporate bonds have maturity level uh, short as compared to T bonds, a few years to long term securities. It may be 5 years or 10 years or 30 years. As compared to treasury bonds, corporate bonds have low maturity levels. And the next is liquidity. Liquidity means convertible into cash. So uh, the treasury bonds are highly liquid with a large and active secondary market because these are backed by government. So it is very easy to convert into cash. It is easy to buy and sell in open market. Uh, whereas whereas you can say corporate bonds are less liquid as compared to T-bills. T-bills are highly liquid, whereas corporate bonds are less liquid. It is not as easy to sell it or buy or sell it as T-bills are. Whereas another differentiating factor is the risk of default. In case of treasury bonds, the risk of default is almost zero because these securities are backed by government, whereas corporate bonds has the risk of default depending upon the rating or credit rating of the company. So these are few differentiating factors. Here we have two different formulas to calculate yield. You can see that yield of or the interest rate of corporate bond or treasury bonds. In case of like uh, first is risk-free rate of return. These are same in both of the bonds. Inflation premium is also same. Maturity risk premium is also same. Whereas you can say that default risk premium is there in corporate bond because we have just discussed the risk of default is almost zero in case of treasury bonds. So we do not have any risk of default here, and the liquidity premium is also in the case of corporate securities or corporate bonds, whereas there's no liquidity risk or liquidity risk premium in case of treasury bonds because these are highly liquid and can be easily converted into cash in open market. You can anytime go and convert into cash. So that's why these two risk are not in the case of treasury bonds. So this is the difference here. The next we can discuss in simple word, what do we mean by real risk free rate of return, or it is represented by R star. So R star, the rate that would exist on a riskless security in a world where no inflation was expected. So it is in simple case you can say that this is R star is the rate of return on investment with no risk of financial loss or adjusted for inflation. Whereas next is inflation premium. Inflation premium is the return that investor require to compensate for the expected decrease in the purchasing power due to inflation over the life of the investments, or in simple word we can say that it reflects the proportion of investment rate that are accounted for anticipated rise in prices. The next is maturity risk premium. So it is the return that investor required to compensate for increased risk associated with holding a longer term bond or investment. This depend on the time period. Maturity means whether the bond is for 10 years or to 20 years or 30 years. So there is risk that the possibility that the borrower may not meet their debt obligation either by failing to make interest payment or not repaying the principal amount. So this depend on the longer term bonds. The next is liquidity premium. Liquidity premium is the return of or the interest that investor demand for holding a security that is not easily convertible into cash without a significant loss of value. And we have just discussed that treasury bond has no liquidity risk premium where because it can be easily converted into um, cash, whereas corporate bond has liquidity risk premium. And the last is default risk premium. Again, the default risk premium is that the investor demand as to compensation for the risk that a borrower might default on a loan or bond. So we have discussed in the start of this lecture that treasury bonds are less risky or the risk of default is almost zero because these are backed by government, whereas in case of corporate bonds, yes, there is a default risk. So these are five different type of risk or default that are the part of yield or the calculation of cost of money. So we will discuss some problems from uh, chapter 6, and the book is Fundamentals of Financial Management from Brigham Houston. Here is the problem. This problem is 6-2, and we have already discussed we have two type of yield or return. One is corporate securities, and this is denoted by R. C. R stand for return or the rate of interest or the yield. C is for corporate bonds. Whereas for T bills or treasury bonds, we use RT, and you can see that the differentiating factor from these two are liquidity risk premium and default risk premium. Default risk premium and liquidity risk premium is zero in case of treasury bonds. So we do not have these two risk premium in treasury bill. We do not consider this. Here the problem is 6-2. We are going to start 6-2. You read in the Wall Street Journal that 30 days T-bills. So we are talking about T-bills, yani RT. We are discussing RT. So yield is given, RT is given 5.5%. Your brother-in-law, a broker at Safe and Sound Securities, has given you the following current interest rate premium. Different data is given, IP is given, liquidity premium, maturity risk premium, and default risk premium is given. And what is required based on the data, you are required to calculate real risk-free rate of return. Real risk-free rate of return. Here we have this formula regarding to treasury bonds. So we can take this here. We will do, we will complete it via this formula. So RT is given yield 5.5%. Inflation premium is given this one 3.25%. Then liquidity premium is given 6%. 0.6%. Maturity risk premium is given 1.8%. Default risk is given 1.25%. And what is required? R star is required. So class, first of all, in case of yield on T-bills, there's no need to consider liquidity premium and default risk premium. And another thing is the time period of T bills is 30 days. So there's no need to consider maturity risk premium, because maturity risk premium is considered if the security or the bonds are more than 1 year. So in this particular case, we will not consider MRP or maturity risk premium, because the T bills are just for 30 days, that is for 1 month. So we are going to calculate it via this formula RT. RT is given 5.5%. So 5.5%. Then on the other side, R star is not given. So we will consider R star plus inflation premium is given, which is 3.25%, 352%. Then maturity risk premium is zero. Why? Because maturity risk premium is considered if the bond is more than 1 year. So this is just 30 days, so we will not consider it. Now by cross multiplication means 5.5%. This 3.25 will convert into minus 3.25%. Then on other side we have R star. So R star would be this one. Now convert it into percentage. In case of uh, this one. In case of percentage, the answer is 2.25. So R star is 2.25. R star, real risk-free rate of return. Real risk-free rate of return is 2.25. This is problem number 6-2. So the next problem is 6-3. We will cover 6-3. And in 6-3, the real risk-free rate of return is given. Inflation is given in different way, that inflation is expected to be 2% this year, means first year inflation is different, and 4% during the next 2 years. So inflation is different, maturity risk premium is zero. What is the yield on 2-year treasury securities, and what is the yield on 3-year treasury securities? So the data is given R star, real risk-free rate of return, which is 3%. Okay. Next is inflation, expected to be 2% this year, means first year inflation is 2%. And during next 2 years mean inflation from second and third year. Second and third year is 4%. Maturity risk premium is zero, and RT2 means yield on treasury stock or T bills, if the T bills are for 2 years and if the T bills are for 3 years. Both are required. So there are two requirements. Here we have the formula related to RT. So first of all, we need IP, inflation, for 2 years, because we are going to calculate, here you can see, we are going to calculate RT2. 2 stands for 2 years if the T bills are for 2 years, and RT3 if T bills are for 3 years. So for RT2 and RT2 and RT3, inflation is required. So average inflation for 2 years. How we will calculate it? First year inflation is 2%. Second year inflation is 4%. So we will divide it by 2 in order to calculate 2 years average inflation. So 2 years average inflation would be how much? 3%. We will convert it into percentage, 3%. And similarly, we will calculate average inflation for 3 years. So 3 years we will have, first year inflation is 2%, and second year and third year inflation is 4%. So we will take 2% plus 4% plus 4%. And how many years are there? Three. So average, we will divide it by three so that we will get average inflation of 3 years. Now we will convert it into average inflation, and in percentage, it is 3.33%. Now we can calculate RT2. Formula is R star. So here we have R star is 3%, average inflation is this, and maturity risk premium is 0. So here's the calculation. R star is 3%. Add inflation, 2 years average inflation is 3%, and maturity risk premium is 0%. So RT2 is, when we add, we will get 6.0%. So this is the first answer, RT2, and RT3, 3% is the R star. Then add inflation period, inflation premium, which is 3.333%. Maturity risk premium is 0 in this problem. So we will get 6.333%. So RT3, or you can say yield on treasury securities, 2 years treasury securities is 6%, whereas yield on 3 years treasury securities is 6.33%. So that's it from this problem. Then we will cover 6.4. In 6.4, we can check the data given. The treasury bonds that mature in 10 years has a yield of 6%. RT, R, because we are talking about treasury bond, R means yield or 10 years. So 10 years treasury bonds is 6%, whereas 10 years corporate means CRC. R mean yield, C corporate, 10 years is 8%. So here this is 8%. Assume that the liquidity premium on corporate bond is 0.5%, so 0.5%. What is the default risk premium? So default risk premium is not given, it is required. Now we can see simple the difference between these two formula, yield on corporate securities and yield on treasury securities. The difference is basically two things are the differentiating factor. The first is liquidity premium and the default risk premium. We do not have default risk premium or liquidity risk premium in the treasury bill formula. So the main differentiating factor is basically these. So the difference between these two are default risk premium. We can write it, the difference between capital RC and RC minus RT is, what is the difference? Difference is default risk premium plus liquidity premium. Here from these two formula, we can derive this particular formula, the differentiating factor. So now we can write the RC is 8%, which is given, minus RT is 6%, 6% is given. On the other side, default risk premium is not given, plus liquidity premium is how much? 0.5%, 0.5%. Here, why it is, we can, this one. Okay, so by deducting 6 from 8, we get 2%, and this 0.5 will deduct from 2, 0.5%. So we will get default risk premium. We will get on it other side, default risk premium. So how much default risk premium? Default risk premium is 1.5%. So this 1.5% is the answer of this particular problem. Then next problem, we will cover 6-5. And the data which is given is the real risk-free rate of return, or R star, is given 3%. Inflation, average inflation of 2 years is given, and the treasury, 2 years treasury yield is given. MRP is not given, so we will have to find out maturity risk premium. In simple words, we have R, R star. R star is 3%. Then IP, average inflation, is given, which is 3%. Then yield means RT, yield on treasury stock of 2 years, is given, which is 6.2%. And what is not given? Maturity risk premium is not given. We will have to find out. We have this formula, we copy this formula, and here we are going to find it out. So RT is given, which is 6.2%. So 6.2%. On the other side, R star is given, which is 3%, plus inflation is also given, average inflation premium, which is 3%. And what is not given? Maturity risk premium is not given. So 6.2% minus 6%. On the other side, we will get maturity risk premium. So maturity risk premium would be 0.2%. So here it is, the answer of problem 6-5. Maturity risk premium, we have calculated maturity risk premium. Then 6-11, which is related to the calculation of default risk premium. So first we will extract the data. A 5-year company's bond yield. Company's bond means RC, 5 is given. Treasury bonds with the same maturity yield is 5.2%, means RT 5 is given. So first we will extract the data, and in data we have RC5, which is 7.75%. On the other side, we have RC5, which are RT5, treasury bills. RT stand for treasury bills. So RT5 is 5.2%. So these two is given. Then real risk-free rate of return is given, which is R star, and real risk-free rate of return is 2.3%, 2.3%. Then average inflation premium, means IP is given, IP is 2.5%. And then maturity risk premium. Maturity risk premium is not directly given, but you will have to calculate it with the formula of this. So maturity risk premium, MRP is 0.1 multiplied by T minus 1, and then percentage. So we will have to calculate it. How? This T represent basically the number of years to maturity. So RCRT, these are 5 years. So, this means that T is 5. And here we can calculate MRP, or maturity risk premium. We take 5 instead of T. 5 means the number of time or number of years to maturity, minus 1, and then percentage. So here we can calculate it in this way, like we multiply all these. So this is the answer. MRP is basically 0.4. We have calculated MRP. Okay, but this is the not requirement. Other is liquidity premium. LP is given. How much liquidity is premium? 1%. It is given. What is required? Default risk premium is not given. So we will have to calculate default risk premium. And default risk premium is present in corporate securities. So we will take this formula. Now, yield is given. This is a yield of corporate security is 7.75%. On the other side, we have R star, which is 2.3%, 2.3%. Then we have inflation premium, which is 2.5%. Then we have maturity risk premium, default risk premium in the formula. So DRP is not given. Then in the formula, we have liquidity premium, which is 1%. Then we have maturity risk premium. We have calculated it is 0.4%. So while take all the percentages on other side, so 7.75% minus 2.3% minus 2.5% minus 1% and minus 0.4%. What we will have on the other side? Default risk premium. So default risk premium would be, by calculating all these, default risk premium here, it is 1.55%. It is 1.55%. So this is the answer. Default risk premium is 1.55%. Now we will move toward, we are moving toward second last problem for this lecture. Here we have, next is 6-12 and we will have to calculate MRP. So let's start the next problem. Inflation premium is to be 2.5% for year 1. पहले साल का उन्होंने इन्फ्लेशन प्रीमियम दिया हुआ है, दूसरे साल का अलग दिया हुआ है और तीसरे साल के बारे में कहा हुआ है दिस इन्फ्लेशन प्रीमियम इज ईच ईयर देयर आफ्टर, मींस आफ्टर from 3 years onward the inflation would be 6.3% each year. Assume that risk-free rate of return or R star is also given and this remains constant. 3 years treasury securities RT3 is given. Then 5-year treasury securities RT5 is given. And what is the requirement? The requirement is the difference between MRP of two securities, that is MRP 5 minus MRP 3, because we have two different securities. One security is for 3 years, one security is for 5 years. So both securities have different maturity risk premium. So we will have to calculate the difference in maturity risk premium of these two. So first of all, we write the data or extract the data. Inflation IP year 1 is given, which is 2.5%. Then IP inflation of year 2 is given, which is 3.2%. Then inflation IP from 3 and from 3 years and onward is given, which is how much? 3.6%. 3.6% here, this one. And then R star real risk-free rate of return is given, which is 2.75%. Then yield on securities. Which securities? Treasury. That's why we write T here. RT for 3 years is given, which is 6.25%. Then RT for 5 years is also given, which is 6.8%. So what is required? Basically required the difference between maturity risk premium of 5 year securities minus maturity risk premium of 3 year securities. The difference between these two securities. So we will find out first of all what is MRP 5 and what is MRP 3, and then we will deduct both MRPs with each other. So inflation for 5 years average and inflation 3 year average inflation premium is required. So in workings, first of all, we will calculate IP 3 years, and IP 3 years would be first year inflation is 2.5%, plus second year inflation is 3.2%, 3.2%. Then third year inflation is 3.6%. So we will take 3.6 percentage, and because this is average, so it will be divided by 3. So the average inflation would be, this 3 years average inflation would be how much? We will calculate it via percentage. 3.1 is the answer. 3.1 in average inflation for 3 years. And similarly, we will calculate IP5 for 5 years average inflation. First year inflation would be 1.5%. Second year inflation would be 3.2%. And third year inflation is 3.6%. And 4 year and 5 year and 6 year, from 3 years onward, the inflation is 3.6. Here it is written that 3.6 each year thereafter. So fourth year it would be 3.6. Fifth year it would be again 3.6 and onward. And we divided by 5 because we are taking 5 year average inflation. So the answer would be converting this amount into percentage, we will get 3.3%. So average inflation for 5 year is 3%. Now we can calculate MRP5 and MRP 3, because the formula has RT means treasury stock is there, treasury securities is there. So we can use this formula for treasury securities. RT 5 is 6.8. So 6.8% is the yield. On the other side, we have R star, which is 2.75%. It is given, plus average inflation. We have just calculated 5 years average inflation, which is 3.3%. Then we add MRP for 5 year. It is not given. Okay. So moving this 2.75 and 3.3% on the other side, 6.8% minus 2.75% minus 3.3%. On the other side, we will get maturity risk premium of 5 years. So by calculating all these amount, we get maturity risk premium. How much? MRP, MRP 5 years. So this is 0.75. Similarly, we will calculate MRP for 3 years. 3 years yield is 6.25. So we will take 6.25% on one side. On other side, we have R star, which is 2.75%. Then we will add average inflation of 3 years, which is 3.1. We have calculated it, 3.1%. And then maturity risk premium of 3 years. Further, we simplify it, 6.25%. We deduct 2.75%, and then we will deduct 3.1%, so that we get maturity risk premium of 3 years, average 3 years. So the answer would be maturity risk premium of 3 years. What is the answer? We convert this amount into percentage, we will get 4%, so 0.4%. Now, what is required? Basically, the requirement is the difference between MRP 5 and MRP 3. So we will deduct MRP 5, the difference between MRP 5 and MRP 3 is simple, 0.75% minus 0.4%. And the answer would be this one. So this is our answer, the difference between these two securities. 0.35. So the 0.35 is basically our answer. The requirement is the difference between these two MRPs, maturity risk premium. So the last problem for today's lecture is 6-13. So the data which is given, R star is given, inflation is given, different inflation rate for different years. Now 2.8% for 4 years, and after which inflation is expected to be 3.75 a year onward. So maturity risk premium is 0, and 8-year corporate bond is given, yield is given, and liquidity risk premium is given. What is required? Default risk premium is required. So first we write down the data. We have, first of all, we have R star is given, which is 2.5%. Then inflation is given IP from year 1 to year 4. Okay. So from year, because it is written, it is mentioned that inflation for the first 4 years is 2.8%. Now inflation IP from year 5 and onwards is different, which is 3.75%. The next is MRP. So there is no MRP. MRP is 0%. Then yield. Yield means R. C means corporate, or time is 8 years. So RC8 is given, which is 8.3%. And the last thing which is given is liquidity premium, LP, which is 0.75%. So this is given. What is required? Default risk premium is not there. We have to calculate default risk premium. The formula is this. So RC8 is given, which is 8.3%. On the other side, real risk-free rate of return 2.5% is given, plus inflation. Now, inflation is not given for 8 years. So we will have to calculate average inflation, IP, for 8 years, okay? So for 8 years, first 4-year inflation is 2.8%. So 2.8% for year 1, 2.8% for year 2, 2.8% for year 3, then 2.8% for year 4. Then next 4-year, it would be 3.75. So we will add 3.75 for year 5, 3.75 for year 6, 3.75 for year 7, and then 3.75 for year 8. And we will divide it by 8 because 8 years average inflation is required. So the answer would be, we will convert this figure into in percentage. So answer is 3.275. So average inflation for 8 years is 3.275. Then we will add default risk premium. So default risk premium is not given. So DRP. Then we will add liquidity premium, which is 0.75%. Then we will add what we will add maturity risk premium, which is 0%. So it is 0%. And here it should be the sign of percentage. So 8.3%, and we will take all these amount, all these percentage on the other side of sign of equality. So by deducting all these percentages, we will get default risk premium 275%, then 0.75%. And on the other side, we will get default risk premium. So default risk premium would be here. So convert this answer into percentage. 1.775%. So this is the answer. Here we have default risk premium. So that's it from this lecture. We have calculated default risk premium, and we have learned how to calculate yield or the cost of money, or you can say the interest rate or rate of return on two different type of securities. If the securities are treasury bills or the securities are corporate securities. So we have two different type of formula. One is for T-bills and other is for corporate securities. Only the differentiating factor is default risk premium and liquidity risk premium. So that's it, class. Take care.